As the week draws to a close, markets are gradually waking up from the holiday season. We note the high number of financial releases in the next week, making it start on Monday with the release of Germany's industrial orders rate for November, Switzerland's CPI rate for December, and Eurozone's Sendex index figure for January. On Tuesday, we note Japan's Tokyo core CPI rates for December, Australia's retail sales rate, and Germany's industrial production rate both for November, and lastly, Canada's trade balance figure for November. On a quiet Wednesday, we note Australia's CPI rates for November and Norway's CPI rates for December. On Thursday, we note Australia's trade balance figure for November, followed by the Czech Republic's and the US CPI rates, both for the month of December, and closing off the day is the US weekly initial jobless claims figure. Finally, on a busy Friday, we note China's PPI and CPI rates and trade balance figure, all for the month of December, followed by the UK's preliminary GDP rate, industrial output rate, and manufacturing output growth rates, all for the month of November, France's final HICP rates, and the US PPI rates, both for December. The USD seems about to end the week in the greens, ending its 3-week losing streak. On a monetary level, we note that FOMC's December meeting minutes, which were released during Wednesday's American session, tended to verify that the bank has likely reached its terminal rate and that rate cuts are on the menu for this year. Yet market participants who may have been hoping for validation of the current market expectations of 6 rate cuts this year, beginning on March, may be somewhat disappointed that several policymakers implied that the current level of interest rates may need to stay for a longer time period, a view we tend to agree with. As such, we may see support for the dollar should the Fed follow through on its intentions. On a macroeconomic level, we note the release of the ISM manufacturing PMI figure for December on Wednesday, which implied a narrowing in the contraction of economic activity for the US manufacturing sector, which may have aided to the dollar's ascent. Yet, market participants may be more interested in the release of the US employment data later on today, where should it be implied that the labor market remains tight, we may see the dollar gaining and vice versa. We place a heavy emphasis on this financial release, given that it will be the first major release for the new year and could have a significant impact on the greenback. Looking at next week, dollar traders may be interested in the next week's CPI rates for December, where should it be implied that inflationary pressures are easing further, it could weigh on the dollar, as it would allow market expectations for the Fed's actions to solidify. Lastly, we also note the PPI rates for December, which are to gauge inflationary pressures at the producer's level. The pound is about to end the week lower against the euro, the US dollar, yet stronger against the JPY. On a monetary level, we note the relatively quiet week from BOE policymakers, and as such, pound traders may be more interested in the financial releases stemming from the UK. In particular, the S&P manufacturing PMI figure for December tended to highlight the potential dire situation of the sector, yet market worries tend to be balanced by the increased economic activity of the services sector. Nevertheless, we maintain our concerns for the UK economy heading in 2024, and as such, pound traders may be interested in next week's financial releases, where the UK's preliminary GDP rate for November is due out to be released on Friday. Should the GDP rate imply that the UK economy has continued contracting, we may see the pound weakening and vice versa. JPY is about to end the week in the reds against the dollar, the euro, and the pound in a sign of broader weakness. On a monetary level, we note that BOJ Governor Weda appears to have signaled clearly the bank's willingness to abandon the decades-long monetary policy, which may have provided support for the yen. However, we note the earthquake that hit Japan on New Year's Day may be having a monetary impact as well. The earthquake that struck Japan, which measured the 7.6 magnitude on the Richter scale, may place higher barriers for the bank to change their monetary policy stance, as the economy may not be able to withstand such a large change under such circumstances. As such, the bank may delay any potential change in its monetary policy decision, which could weaken the yen. On a macroeconomic level, we know Japan's Tokyo core CPI rates for December, which is due to be released next Tuesday. Should the core CPI rate imply that inflationary pressures are persisting in the Japanese economy, the need to abandon the bank's ultra-loose monetary policy may be enhanced, thus potentially supporting the yen and vice versa. The common currency is about to end the week in the reds against the US dollar and GBP, but higher than the yen. On a monetary level, we note the relatively quiet front from ECB policymakers, and as such, our attention turns to the financial releases stemming from the euro area this week. In particular, we begin with the manufacturing PMI figures for December for the euro area as a whole, Germany and France, which all came in better than expected earlier on this week. The better than expected PMI figures may have provided some relief for the euro, yet we should still note that despite the narrowing contraction of the manufacturing sector, it is still in contraction territory, and the better than expected figures are just barely higher. As such, despite the PMI release, it may be concerning for Eurozone's economy that the two largest countries in the bloc continue to experience a contraction in the manufacturing activity, as it could heighten fears for a potential recession in the bloc. Therefore, from a macro perspective, we may see the euro weakening should the recession fears intensify. Moreover, despite December's lower than expected preliminary HICP rates for France and Germany on a month-to-month level, they are still higher than the last readings, implying entrenched inflationary pressures in the bloc. Hence, should ECB policymakers maintain the call to maintain rates at the current levels for a longer period, we may see the euro getting some support. AUD is about to end the first week of 2024 in the reds against the US dollar. On the monetary front, we note that RBA's interest rate decision that was due to occur on the 2nd of January appears to have been pushed back to the 6th of February. On a macroeconomic level, we note the release of Australia's manufacturing and services PMI figures, both for December, which both came in lower than expected, implying a wider contraction of economic activity in both the manufacturing and services industries. The lower than expected releases may have weighed on the Aussie during the week. On an economic level, we turn our attention to China, who released its NBS and extreme manufacturing PMI figures for December, which continue to contradict one another, and as such may have led to increased volatility in the Aussie given the close economic ties. On a fundamental level, we note the increasing tensions between the island of Taiwan and China, which could lead to increased volatility in the region and could weigh on the Aussie in the near future. The loonie is about to end the week against the US dollar and the reds. On a fundamental level, we note that oil prices over the week are on track to end the week slightly higher. As such, should oil prices continue their upward trajectory, we may see the high oil prices providing support for the loonie, giving Canada's status as a major oil producer. Moreover, with the continued tensions in the Middle East, and in particular in Iran, Red Sea closing and Libya, we may see oil prices remaining slightly elevated over the next week. On a macroeconomic level, we note Canada's employment data, which is due to be released later on today during the American session, which is expected by economists to highlight a loosening labor market and as such could weigh on the loonie. Yet Canada's IV PMI figure is expected to increase, which may imply an expanding manufacturing industry for Canada and as such could provide some comfort for CAD traders. Lastly, loonie traders may be interested in Canada's trade balance for November next Tuesday, where should it come in higher than expected, it may provide support for the CAD and vice versa. Overall, we expect market activity in the coming week to intensify as we kickstart the new year with key financial releases. In regards to US stock markets, we saw the bears taking control over the markets, with all three major indexes seemingly on track to end the first trading week of the year in the reds. We also note that the US bond yields, in particular the 5-year and 10-year, moving higher this week. Lastly, we note that volatility appears to be picking up in the Middle East, with Iran having faced a terrorist attack and protests hindering the production of Libya's largest oil field, which may lead to elevated oil prices. Moreover, the heightened risks of attack by Houthi rebels in the Red Sea appear to have intensified, and as such, hindering passage through one of the world's most vital trade arteries could have an impact on the global economy. Lastly, tensions between Taiwan and China appear to be escalating, and as such, we are keeping a close eye on the developments as they could upset the delicate stability in the region. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
everyone. The term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen, and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Good afternoon. Hi, Atur. Hi, Owen. Just want to check that you guys can, before we get started, you can hear me okay? You can see me all right? Let me know, put it into the chat. Sound and screen okay? Fantastic. Seems like everything's okay. We'll give it a couple of minutes before we get started. And while we're waiting, let me know where you're joining me from. And I hope you've had a good trading day, or trading week, or a good start to the new year. And a happy new year to everyone as well. Hey Techno, how you doing? Hey Aya. We'll see who else streams in before we get started. Give it a couple of minutes. Today we're here with IronFX on the webinar series Mastering Divergence in Trading. Quite a number of things to get through today, so it'll be quite an interesting session. I hope you find it an interesting session and helpful as well. Hi there from Germany. Good to see you. Hey Esther, how are you doing? As we're going to be talking about divergence trading today, let me know if this is a strategy or method that you deploy onto your own trading as well. Do you use divergence? Do you trade with the divergence? I'm very well. I've had a couple of nice trades last night and also this afternoon, so I'm super happy with that. Hey, Promise, how you doing? Fantastic. Good to see. Does anyone attending the session use divergence in their trading? Why I'm asking is just so that I know, how fast or how slowly or how much detail to get into, customize the session a little bit more for you guys. Do let me know. Alrighty, let's get started. So again, welcome to everyone attending the session, and thank you all for attending the session. I know a couple of you have been waiting to join up, so thank you all for attending early and welcome to the session. Today we are here with IronFX on the webinar series, Mastering Divergence in Trading, right? So before we get started, a quick disclaimer is that any information in this webinar should not be construed as investment advice or an investment recommendation, but instead as educational material only. This material is the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you some ideas, some thoughts, the way to deploy divergence in your trading. What I do usually recommend is that whatever you learn here during this session, I would suggest that first you test it out, right? You read up a little bit more about it, you understand it a little bit better, then test it out on a demo account first, right? Never jump straight into a live trading account with a new strategy or a new method. What you're gonna do is test it out on a demo account. Make sure that you understand how it works. Make sure that you're able to identify the way it works on a demo account. Then you progress on to trade it, I would say, on a smaller trade, right? So size down when you go into a live account, size it down, test it out further. Once you gain that confidence with the method, then you can resume and possibly integrate it with your existing trading strategy. Okay, so these are all, I feel, complements to your trading strategy, not something that I think should overtake whatever you're currently doing. All right. So a quick introduction. My name is Jindao. Most of you will know me as Jin. I'm been trading for 10 to 15 years now already, so quite a long time. If you do have any trading related questions, please feel free to reach out, let me know. I'll be happy to address your questions as they come up. Okay, so today we're talking about divergence when we are in trading, right? Using different price levels and also the tools and indicators to help us to identify possible divergence. All right. Good to go. Any questions at this point? I do see that a couple of you are new to trading. So what I would suggest is that, this might be something that you want to look further into. It is a very powerful and quite commonly used method that a lot of traders monitor and deploy with their trading. So I think this might be a good starting point, right? And it's relatively simple to understand, relatively simple to analyze and to deploy. So it might be something that you might want to look into a little bit deeper as we progress through this session. So with that, let's get going. Couple of things to get through today. First off, obviously, what is divergence in trading? right? What is divergence in trading? And, as the word, let me just get that up. As the word suggests, divergence, right? Just plainly explained, in divergence means one thing is going towards upside and then something else is going in opposite direction, right? Obviously, everything is moving towards the right, but one is moving higher and then something else is moving lower. Or in the flip side, I should change the color. Let me just do that. All right. Or on the flip side, one goes down and then the two goes up. That's a terrible color. Sorry about that. Okay. So first off, what is divergence in trading? That's when we actually see price moving. So I always say that top level here is price. Price moving in a different direction to what the indicator is telling you. I can't scribble with the mouse, but what the indicator is telling you. So very commonly, most often, we always see, price moving in the up towards the upside, and then we see the indicator pointing towards the upside. So this is the common view, is that we see price pushing higher, while the indicator, for example, the RSI, is pushing towards the upside as well. So that's what we saw. We say a confluence, we would say it's moving in alignment, right? Indicator pointing in the same direction as price. When it comes to divergence, it's when price moves up, but we actually see the indicator pointing towards the downside or moving lower. What indicators can you use to identify a divergence? First off will be price at the top, but in terms of indicators, we can use the stochastic, right? We can use the stochastics, we can use the RSI, or we can even use the MACD, the moving average, convergence, and divergence. Quite commonly, the question I would get when I come to this point is that, people will be asking, so which is better? Should is the stochastic better than the RSI, or is the RSI better than the MACD, just based on the sequence that we're sharing? There is no better indicator to use. It all performs in a similar fashion, right? All performs in a similar fashion, but what it should actually tell you a similar story, identifying that similar setup for you. So it really doesn't matter whether you use the stochastic, the RSI, or the MACD. Sorry about that. I'm still coughing terribly, so just bear with me there. Okay, so different indicators still would tell you a similar story. Then after that, on point 3 here, so this is 2, and this was 1. On point 3 here, we have different types of divergence. Different types of divergence. There are normal divergence, there are hidden divergence, and the exaggerated divergence. Now, put it into the chat. What do you think is going to give you a bigger possible potential move when you identify divergence? Normal, hidden, or exaggerated? What do you think is going to give you a bigger price movement? Normal, hidden, or exaggerated? Okay, right? Yes. So good stuff there, right? It exaggerated tends to give you, or would tend to give you, a bit more of a potentially bigger price movement. But there are other things to consider, not just the types of divergence. And then with that, when we understand how to use the indicator, how to identify the different divergence, we'll combine them all together to look for our trade setups. Okay, so quite a number of things to get through today. At any point, if you do have questions, please feel free to put into the chat, let me know. And also, if time permits, what I'll do is at the end of the session, I'll jump into a live charts and try and identify some divergence or live occurring divergence for you guys. Sounds good? Alrighty. So first off, the different, well, jumping ahead a little bit, the different types of divergence. Like I was telling you, okay? So I remember that on the top, splitting this, on the top is price, on the bottom is indicator. So there's the blue line and the red line. That's the regular divergence. The hidden divergence, again, price and indicator. And then the exaggerated divergence in terms of price and indicator. Okay, so how do you identify a divergence? Right, let's look at the regular divergence first. How do you identify a regular divergence? We split the divergence up into a bearish divergence or a bullish divergence. As the name describes, if we have a bearish divergence, what we anticipate is for price to drop strongly. If we have a bullish divergence, then we anticipate that price should climb higher. So things to pay attention to is the turning points on price, right? So we're looking for price to move up, turn back down, move up again, turn back down. So we have a higher high, and then another higher high. So when you have higher highs, you say that that's the first part one. Okay, this is what we have here. And then you look at the indicators, right? For example, in this case, let's say the RSI, and you're looking for it to form a lower low. So in this case, as the indicators might go down this way, bounce back up, turn back down, and then turn this way, you say this is a low and a lower low, right? So you say that we have a divergence, a bearish divergence, price forming higher highs, or the peaks of price forming higher highs, and the indicators forming lower lows. All right, so with that, we will anticipate that price would retrace or correct towards the downside. Remember, the things to remember here is that when you're looking at bearish divergence, you're almost somewhat identifying a upward trend line, right? Or a trend line that's resisting, providing that resistance to price, right? So it's hit the price resistance once, twice, and then a big retracement towards the downside. In terms of a bullish divergence, you're looking for a lower low in terms of price, a lower low in terms of price, and a, when price goes this way, no, let me do that again. All right, so when price goes this way and then this way, so now we have that trend line towards the downside, and then we have a lower, a higher low, right? A higher, this will be a lower high, pardon me, this will be a lower high. Then we have that divergence towards the upside. So they will call this a bullish divergence. Okay, so I'll take that away. I think the regular divergence is relatively straightforward in terms of identifying it, because we're looking for that higher highs and the lower highs in terms of the bearish, and the lower lows and the higher lows in terms of the bullish divergence. What happens with the hidden divergence? What happens with the hidden divergence is when you actually see price moving lower. So you have in this case, a high, and then we have a lower high, while we have the indicator actually giving us that, a high and then a higher high. All right, so it looks like it's pointing towards, it looks like those lines will be converging, pointing towards the same meeting point. That's what we'll have, the hidden divergence, a bearish hidden divergence. And then when we look at the bullish divergence, it actually separates out. It points further apart. You can see here, it's formed by a low and then a higher low, right? A low and then a higher low, while the indicator will be formed with a low and then a lower low, where you would have the divergence pointing in separate directions, one pointing towards the upside, one pointing towards the downside. That would say a bearish, or rather a bullish hidden divergence. And then lastly, the exaggerated divergence. That one is relatively straightforward to identify because we're looking at price not forming that diagonal move, right? We're not looking at a higher high or lower high in what we had on the regular or the hidden divergence. What we're looking for in the exaggerated divergence, whether it's bullish or bearish, we're actually looking at price trading or forming a good, strong horizontal resistance or horizontal support level. Okay, so you can see here where we have here at this point, price testing, before testing again, horizontal level, right? A horizontal resistance, not looking for the higher highs or higher lows, and then, but the indicator forming a high and then a lower high, right? So you have price resisted to move towards the upside, but yet you have the indicator pointing towards the downside or trending lower. That's why we would say we have the exaggerated divergence on a bearish note. And then on a bullish note, we'll have it forming a support level, right? At a support level, while the indicator is forming a low and then a higher low, indicating further upside or indicating that bullish potential. All right. So quite a number of things to take note of in terms of identifying or understanding the different types of divergence. While this session is being recorded, what I will also suggest to you guys will be to, take a quick snapshot or do a quick scribble in terms of the the 6 different divergence, the bullish, the bearish divergence for the regular, for the hidden, and also for the exaggerated divergence, right? So this, you can use it as a quick reference guide. Okay, so if you have already, great. If not, let me know. I'll come back to this slide again. So looking at it in terms of on a chart, it's fine. It's relatively easy to identify it when we're looking at it with lines purposely drawn to identify the divergence. But how does it look like on a chart? We have the examples here. You can see that firstly, price is testing a resistance level, right? It's formed. It's almost, if I can draw a horizontal line, you can see it's formed right across, right? Forming a little bit of a smaller high, resulting in a bearish divergence with RSI. So it's tested a bit across, but you can see that in this case, it's moved up a little bit, right? So we're talking about small movements. It can also sometimes be quite obvious, right? Sometimes it's quite hard to identify a divergence or bearish or bullish divergence, but sometimes it's going to be quite obvious. In this case, as a first example, almost horizontal, almost like an exaggerated divergence, but we also would say that it's a bearish divergence here. And then you can see RSI first at this point, and then trending lower, right? So this is a little bit more obvious. You can see it pointing towards the downside. So we either have it going up like that slightly, potentially, and then after that, the RSI forming that. Oops, I'll draw that better. And then the RSI forming that move lower again, right? So we're looking at that And then if I scroll back, you can see that for this to point up and this to point, the indicators trend to point down, right? Pointing up and pointing down, or moving right across and pointing down. So this would tick the examples of either a regular divergence or the exaggerated divergence, which still would give us the indication that we're looking at a potential bearish move towards the downside. Okay, so you can see here, price moving across, right across or slightly towards the upside, and then the RSI here moving slightly lower, right? So we see that divergence, that bearish divergence. And what happens? You see that price traded strongly lower, right? Strongly lower, not just because of the divergence, right? Price reverses strongly from that horizontal resistance level. It also traded lower because the RSI traded down, right? From the overbought region to the almost towards the oversold region. And also because of that bearish divergence. So what I'd like to do, right, as much as we're talking about the divergence here, right, as much as we're talking about the divergence here, I wouldn't recommend, entering a trade just because of a divergence. I wouldn't do it just because of a divergence, right? I'll still be looking at, yes, I'll identify a divergence, but before that, I'm looking at support and resistance levels, right? You can see price resisting that resistance level. You could also be looking at the previous trend. And also you'll be looking at indicators just giving you that signal of where price could be heading towards. Putting all that together, then after that, identifying a divergence gives you that confidence, right? Gives you that confidence because you get a confluence of analysis. You get many things put together, giving you the same signal, telling you that we're potentially looking at some downside. And that's why we see price having moved strongly lower. All right. At this point, any questions? Any questions at this point? Let me know. Or if it's all good, clear and good, let me know as well. And we'll move on. All righty. Okay. So with that, thank you, Esther. With that, we look at, again, another one, right? An idea of a repeated divergence. So now let me ask you, if you see a divergence and it trades well, and what happens? What do you think will happen if you see multiple divergence? If you see it happening over several times? Most likely going to give you a stronger signal, right? A repeat of what could happen. So in this case, quite straightforward. You can see that price pushing higher, right? Moving towards upside. That, oops, I'm terrible with this drawing. Right, you can see price forming a higher high. You can see price having a high there and then forming a higher high. But yet we see the stochastics. In this case, in this example, we're looking at stochastics forming a lower high, right? So this was the high point here, and then it's formed a lower high. So it's pushing towards the downside. Again, as price pushes up and the indicator, in this case, the stochastic pushes down, what we would have is a bearish divergence. And you'll see that, if I can just draw a straight line across, that was the previous resistance level, right? We saw a little bit of a break towards the upside. And then because of that bearish divergence, we saw price come strongly towards the downside. Okay, so this is also one good way or another tool to help you identify potentially some false breakouts. I always get questions from individuals that I coach in terms of how do you identify a potential false breakout. You could use divergence as price breaks out of a resistance level, you see a divergence form, you anticipate that price could trade back down again. In this case, you can see as a